All right, why don't we go ahead and get started? So thank you guys for joining. So my name is Mark LaMonica. I look after the individual investor business for Morningstar here in Australia. We're going to talk about investment strategies today and some considerations about implementing them. But first, we've got a couple of housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand and you want a copy of our FAP, you can come to our website, morningstar.com.au, get a copy of that. And the New Zealand regulatory authorities encourage you to speak to a financial advisor if you would like personal advice. All right, got through the housekeeping. The exciting thing is that this is the last one of the year. Maybe exciting for me, probably exciting for you guys, although it's optional for you to come. But yeah, we'll get started. And yeah, for anyone interested, we will start them up again that second week of January. We're going to take a little bit of a different approach, which we will send an email about, where we'll have a little more structure around them, which I think will be exciting, but we will see. All right. And you can follow us on Instagram and listen to the podcast. Okay. Talk about investment strategy. So I came up with a number of them that I thought people would potentially be interested in speaking through. But yeah, we'll go through these. Ask any questions that you have. It makes it more interesting for me and more interesting for all of you. I feel like I'm not centered in the screen. There we go. All right. So first, we're going to talk about income versus total return. So on the income side, we have, of course, Benjamin Franklin, who's on the $100 bill. So I thought that was appropriate. And then this is Mr. Belding. Oh, that's not supposed to say trading. That's supposed to say total return. Think of that as total return. Okay, let's get into this. So let's talk a little bit about what both of these things are. So income investing, of course, is, well, number one, very popular. But the idea behind income investing is that you are concentrating on generating income out of your portfolio, passive income out of your portfolio that eventually will pay for your life. So the idea behind this at a very high level is that you would like to generate enough income to support your lifestyle and retirement. Versus the total return side of things, which is supposed to say there, versus the total return, where you are just looking at the overall return of your portfolio. And you know, obviously, that there are two different ways that you can get money out of your portfolio. You can make income, but of course, you can also sell things that you have. So what I would say is that income investing resonates with a lot of individual investors. It resonates a lot with me. Whereas sort of the academic approach to investing that's practiced by a lot of professionals is this total return approach. So let's go through a couple of considerations that hopefully will provide a little more detail on both of these. Okay, so first one on income. A focus on income can decrease behavioral risk. So let me explain what this actually means. Behavioral risk simply refers to the risk that you are going to do something stupid. And one of the things that induces, the primary thing that induces investors to do dumb things is volatility. So fluctuations in the value of investments or your overall portfolio. So when the market goes up a lot, people do dumb things like they chase performance, they take on more risk because they don't think that the market's ever going to go down. We're seeing a lot of that right now. There was this interesting article on the ABC yesterday that was talking about this couple that got scammed, which is very sad. But there was this quote on there saying it's not unheard of to get thousands of % returns in a couple of months investing in crypto. Well, it is unheard of, but that is the environment we're in now, right? We're in this environment where people are hearing these stories and makes you more susceptible to scams, makes you more susceptible to take more risk with your portfolio. Same thing on the downside. So on the downside, of course, when the markets are dropping a lot, it encourages people to sell. So that's what we're talking about with behavioral risk. So the reason I put in a focus on income can decrease behavioral risk, because if you are looking at your portfolio and you are not looking at the values that are bouncing around every day, that you are looking to build your income. Number one, income fluctuates. And from income, we're talking about dividends, not a lot right now, but we're also talking about interest off of fixed interest and bank accounts. Pretty hard to get right now. But if you are focused on income, income has a lot less volatility than just a portfolio in general. So what I mean by that is dividends certainly can be cut. We all saw this in 2020. I think that year was a little bit of an anomaly, but still, dividends can certainly be cut. But generally, income does not fluctuate as much, that the cuts in dividends are smaller, that if you're investing, hopefully in the right securities, that you'll just get steady increases in income over time. You'll save and invest more money. That increases your income. You may reinvest your dividends. That will increase your income. That focus on generating income can prevent you, or does prevent you, from focusing on your portfolio bouncing around. So instead of just a number and your investments just being a number, you're very focused on the income that they can generate. This also is true, of course, in retirement. And we'll get into some of that in a second, that you are focused on generating income out of your portfolio. So you're probably going to get less spooked by big market drops, because you're living off of that income, and that's a positive thing. That's kind of the second bullet point. Talking about retirement now. So reliance on passive income can lower your exposure to sequencing risk and longevity risk. Now, why do I say that? I say it basically because, and I think I've explained both of these a lot, but very quickly, sequencing risk is the order of returns. The notion that if you retire and the markets drop a lot, that is going to have profound impacts on your portfolio, because in retirement, you have to sell things. So those stupid behaviors, do not sell when the market's dropping a lot. In retirement, you have to, right? You have to sell to support yourself. You need to take money out of your portfolio, but you don't have to do that if you're relying on income. So if you can generate enough income out of your portfolio to support your life, you don't have to sell. So it's this whole notion of don't invade your principal, right? You only touch income. So if the markets go up, the markets go down, that's fine. That's sequencing risk. Longevity risk is just basically that you get too conservative and you outlive your money. And so those are sort of the twin issues that you're dealing with in retirement. So once again, as long as you're not selling your principal, so your principal, the shares that are generating dividends, if you do not sell them, then you can continue to generate income into the future. So some of the things you need to watch out for. Number one, mandatory drawdowns from super. So we get this question all the time around sort of withdrawal rates and superannuation, required withdrawals. And they're two very different things, right? One, you do have to legally, the super withdrawal rates, you do have to legally comply with those, but you don't have to spend the money. It's a little different from withdrawing it completely from your portfolio, if you think of it more holistically. The problem, of course, is that this notion of living off of your income, you're likely, once you get in sort of the 5% withdrawal category in super, I guess more power to you if you're generating more than that in income, but you're probably not, then you do have to sell things off. So, how do you manage that? The other thing, living off of passive income generally requires a meaningfully higher balance to achieve the same lifestyle. So what I'm talking about here is whether you adhere to the 4% rule. Some of the updated research that's come out of Morningstar that's looked at a 3.3% withdrawal rule. Whatever withdrawal you're doing, it generally is going to be higher than the amount of income that you are able to generate from your portfolio. So what does that mean? It simply means you need more money in your portfolio to generate the same amount. So that's a real downside. But that higher balance could, of course, bring you more peace of mind. It is difficult to generate, and I think a lot of people don't really get this, it's difficult to generate consistent income from collectively managed investment vehicles. So basically what we're talking about here is funds and ETFs, and we'll get to LICs in a second. So what that means is because of the way that funds and ETFs are set up, they have to distribute any income generated and any capital gains generated, any income at all that's generated, whether that's from capital gains or whether that's from dividends. So what that means is if you go back and you look at distributions from funds and ETFs, they bounce around a lot. And they're bouncing around because of capital gains. Like income does change, but it's really the capital gains that are driving those distributions. So a lot of people sit there and say, okay, well, this ETF distributed $1 this year. That's great. So I make $1 of income from this ETF. Next year, it could be 50 cents. So you see these big fluctuations. Now, LICs have a mechanism because they are a corporation, a listed investment corporation, that they do not have to distribute everything. They can wait. So basically what they can do is the manager not only is responsible for buying and selling securities and managing the portfolio, but the manager is also responsible for deciding what income needs to can come out of there, right? So they can set up reserves. And what that allows them to do is smooth income changes. And so 2020 was a perfect example. If you go back and you look at how LICs did, well, a lot of them, the income dropped, but not as significant as other securities. All right. Last one. So when you think about diversification, if you are creating a portfolio where you're trying to live off the income, you're thinking about diversification, you need to tweak it a little bit, right? Like you obviously still want to diversify on a position basis, right? That I don't want to put all of my money into a single share, single asset class, whatever, but you should also look at income. So you want to diversify your income sources. So that can, once again, as we think about different industries and markets and different companies, think about diversification of your income. All right, let's go over here to total return, which should not say trading. One of the advantages, now, once again, this depends where your money is. So if it's in super, you don't really have to worry about this as much. But if it's in a taxable account, the ability to minimize and time taxable events. So what does that mean? It means the problem with dividends are that, of course, you have to pay taxes on them. It's outside of super. So you have to pay taxes on dividends. You also have to pay taxes on capital gains, but you get to choose when you have those capital gains. So just the simple act of not selling something on June 30th and waiting till July 1st buys you another year, right? So simple acts like that you can time those capital gains and you can offset them. So if you've got some losers that are down, you can sell those to offset some of the gains you have. There's all sorts of different things that you can do to manage your tax situation. Now, once again, if your money's in super, this is less of a consideration. So this is just the opposite. The second bullet point is the opposite of what I said before. In general, withdrawal rates are higher than the yields you would get on a portfolio. So you need less money to support your lifestyle. You do subject yourself to more risk, however. Sequencing risk. So as I said, the problem is that if markets start falling as you retire and you're selling assets off, you're selling at the bottom, which means when markets go back up, as they have traditionally done, when they go back up, you have less money to get those gains because you've sold off some of your securities. This withdrawal rate becomes huge, right? So what is a safe withdrawal rate? What happens? What is the bad or good luck that you retire into? So once again, those sequence of returns, you retire, you have the misfortune to retire, then all of a sudden a bear market starts. That's a really bad place to be. And it's, once again, it's not your fault. It's just the luck of the draw, but it's a really bad place to be. And yeah, this volatility. That is volatility in your portfolio going to cause you to do something stupid. And this focus on price and focus on your portfolio value, your net worth, whatever you want to call it. All right. We're going to talk about value and growth now, which I think is an interesting spot to be. There's been some interesting stuff, obviously very short term, that's happened in the market recently, which will hopefully make this make a little more sense. All right. So first, let's talk about sort of value versus growth instead of just going down one checklist. We'll just, it's obviously my fault, but we'll go and look at both. All right. So let's talk about value versus growth, what it means. Number one. Basically, at the end of the day, there are no such thing as value stocks will be value stocks forever, growth stocks will be growth stocks forever. They may be, but all we're talking about with value versus growth is literally what we're doing is we're taking the universe of shares and we're dividing them by valuation measures. So all the ones that have a lower price to earnings, price to book value, price to cash flow, whatever you want to go, will fall in the growth or fall in the value category. Higher valuation measures fall in the growth. It has nothing else to do with any of the securities, but in general, the reason that the market pays more from a valuation standpoint is because they expect more growth, which makes complete sense, right? That I am less focused on today's valuation if I'm going to invest in a company that's going to grow really quickly. Because in the future, that valuation level will either come down if the share price doesn't move as earnings grow, or if it keeps the same, it'll just go up. So that's in general what happens. But what does that mean? If we think back to, and for people who attended the How to Value a Share webinar, we build out these discounted cash flows. And that's how we value a share, right? We build out a discounted cash flow model where we project out cash flows into the future, then we discount them back to the present day. So value, more of the value, because it's growing slower, is closer to today, right? Where growth, a lot of the value because of the high growth rate is way out in the future. If we think about how that exponentially grows. So what does that mean? It means that these companies have different, the interest rate changes and inflation changes, which are often coupled together, have more of an impact if a lot of the cash flows are way out in the future, right? Because we're discounting them by more, and we're discounting them for a longer time if they're a growth share. So hopefully that made sense. But ask questions if it didn't. What does that mean? It means when interest rates go up and inflation goes up, which once again generally go hand in hand, growth shares generally do worse. And this is what we've seen this year. So if you look at what's happened over the past month, and I know the market's rebounded in the past couple of days, if you look at what's happened in the last month, what has really gotten hit? Growth shares. So growth shares have had a pretty bad month because the market is worried about interest rates going up, worried about inflation going up. So that is always going to hit growth shares more than value, where the value is closer to the present day. So just something to think about. We've obviously been in a long-term low interest rate environment. We've been in a long-term environment where interest rates have dropped, and we've seen all sorts of liquidity pushed into the market. What has done very well? Growth. And that makes sense. Just think about what would happen if, and we don't know what's going to happen, obviously, if that changes. If we are in a higher interest rate environment, we start moving into a higher interest rate environment, be wary of how that's going to impact growth shares. And it's happened a couple times this year. It happened in February as well, right? So we had a little surge of inflation, sort of the first one in February. You saw yields go up on bonds and growth shares sold off. And then, of course, the market decided they didn't care about that anymore. And then they kept going up. But look at some of the stuff that's happening. Look at tech stocks, especially tech stocks that are outside, kind of the big ones. Have not done very well. A lot of the more speculative stuff hasn't done very well in the past month. And that is because there's a different relationship with interest rates. All right. Once again, this is a huge generalization. So generally, value shares have lower business risk. So let me talk about what that means. So, and obviously, other side, that higher business risk on growth shares. So what does that mean? So Business risk refers to what is the risk of the business, right? We are buying businesses as shareholders. So some businesses are riskier than other businesses. Larger companies are generally less risky than smaller companies. Now, small companies traditionally have had higher returns if you invest in small caps. But the reason for that, of course, is you're getting compensated for the additional risk. So it's harder to go out of business if you were a giant company with lots of product lines that sells stuff globally than if you were a tiny company selling one product in one very specific geographic area. So think about business risk. More mature industries have lower business risk. So I obviously can't answer these questions because I'm not a biotech expert. But if you have if you buy a small biotech company that's in a very competitive space where there's all these different people, all these different small biotech companies trying to go out there and solve a health problem, that's a lot riskier. There's a lot more risk involved in that than if I am Coca-Cola and I'm selling, soft drinks and other drinks around the world, right? The upside is higher, but the downside is also higher, right? So that's our whole concept of risk. So think about business risk. The other thing that's really important to think about with growth companies is what is priced into the market. That this growth is, once again, it's a lot harder to hit these enormous growth targets that a lot of these companies have embedded in the share price. Basically, if you're some company that's trying to continually grow 15% a year, we all know that that will stop. Right. So that is impossible to do forever. And that over time that will decline and the companies will mature and potentially move over to the value side. But just remember, that's hard to do. And generally, those companies get punished a lot worse if they do not meet those expectations, or the expectations are much lower on this side. On both sides of these, I would say, so you generally get more income from value, generally more capital appreciation from growth. On both sides, certain sectors are heavily influenced. So if you're a value investor, a lot of financials, a lot of energy, things of that nature, sort of what we would call like old economy companies. So just remember, you're getting a lot of exposure to that. In a way, it's kind of like investing in the Australian market, all right? We've got a lot of resources, we've got a lot of financial services. Growth, of course, your exposure is to technology and healthcare and what the sector, communication services, which is what we would all think of as technology, Google and whatnot. So something to think about there. All right, so Lisa's asking, Lisa and her alpacas, or maybe one of her alpacas has passed on the question. If interest rates rise, is it prudent to shift some of our asset allocation away from equities and into bonds and deposits? The problem, Lisa, is that when interest rates go up, bonds, of course, move inversely to interest rates. So interest rates go up, bond prices go down, which is a really bad thing to do. So what you would want to do in an ideal world, which of course is impossible to do, is you would want to invest into bonds and term deposits when you knew interest rates were not going down or not going up anymore. That, of course, is impossible to know. So that's the problem. So, I think it depends how you invest in certainly bonds. Deposits, there is an argument to say that if you think interest rates are going to go up for a while and it's going to have a negative impact on equities, then hey, it's probably good to have some cash, right? So if you keep some cash, keep some powder dry for when there are bigger bargains in the market, I think that's certainly something that would make sense. But once again, we have no idea, right? Like I'm assuming in that scenario that I know that interest rates are going to go up. I know that equities will go down if interest rates go up. We're market timing there, so it's something important to think about. And we have no idea what's going to happen, right? We are obviously just one more variant of COVID from potentially all this stuff we've been talking about with interest rates going up ending, right? We have no idea. We have no idea what's going to happen. All right. So we're going to talk about sort of dollar cost averaging, which is not market timing. I'm going to talk to whoever created these slides, which was me, by the way. We're going to talk a little bit about buy and hold and market timing. So this time, let's just look at these two. So even though I've got the Wolf of Wall Street, but I put that because it said I'm not selling, because that's, kind of buy and hold. And then this guy's really excited because he has lots of monitors and is making some money. But yeah, let's talk a little bit about buy and hold. So buy and hold is obviously a longer term strategy. You literally do what it says. You buy something and you hold it. Market timing is you're this guy with 6 monitors and you're trading all day. And market timing doesn't necessarily have to be trading all day, but anyone who has very short-term holding periods in shares. So something to think about. Professionals all say that they are long-term investors and they're sort of over here, but they're not. Most of them are in market timing. So the average holding period for a fund is about a year. That is not long-term. So fund managers are very much in this market timing bucket. So just remember that no matter what they tell you, no matter what it says in their marketing communications, first thing you should ask them is, what is your turnover in your portfolio? And if it's high, then they are not long-term investors. So you'll notice that I put a lot in the buy and hold. That was sort of deliberate. I'm kind of biased towards that approach. But yeah, let's talk through some of the things. So patience is one of the largest sources of edge for investors. I got an email from somebody the other day, some guy named Dave out in WA, and he ended his email with that quote. So there's this famous investing quote that basically, I'll paraphrase, that the share market is just transferring wealth from the impatient to the patient. And patience is one of the largest sources of edge. So what that means is it's one of the largest advantages that any investor has, to not follow all this noise, to find a great company and understand that there's going to be volatility, but don't look at the market, look at the company. So this is, you hear this from Buffett all the time, right? That his, in an ideal, what does he say? So he says that his ideal holding period is forever. He says that you should buy things and be perfectly happy if the market is closed for 10 years. So what that means is that he bought a business. He doesn't care that every 10 seconds he's getting a new bid for what his business is worth and a new evaluation for what it's worth. He doesn't care. He's looking long-term at the business. So difficult to do, but very, very effective to have more patience than somebody, right? So if we want to do better than somebody, we have to do something different, right? If we do what everyone else does, that's average. Maybe that's good enough. But yeah, that's average. Once again, behavioral benefits. So that if you are, and you have it ingrained in your head that you were a buy and hold investor, you will naturally start ignoring all of this short-term activity because you don't care, right? You're not spending every day trying to figure out, should I keep my position in ZIP as it continues to go down? You're not concerned with that. I'd also say if you were a buy and hold investor, you wouldn't invest in ZIP. That's my personal commentary. Favorable tax advantages. Yeah, so we all know the difference between short-term capital gains and long-term capital gains. If you don't, the very quick summary is that you pay less tax if you hold something for longer than a year. So holding things for longer periods of time means less taxes. It means lower transaction costs. All of these things that really matter to what our total return is. One of the downsides of buy and hold is you can become emotionally attached to positions in your portfolio, and you can fail to reassess your thesis, right? So if you're a buy and hold investor, your theory is, I'm going to buy a share for a certain reason. I'm going to buy a company for a certain reason. And I don't care about the price, and I don't care how much it bounces around. As long as my thesis on that company is intact, I am not selling it. Now, the problem is, taken to an extreme, is people become very attached to these securities and they simply don't sell no matter what happens. So you can miss things when the nature of the company or the nature of the competitive environment the company is operating in significantly change. So that is something that you need to think about for buy and hold, to make sure that you are still looking at this company and assessing it correctly and not getting emotionally attached. The other thing I can really come up with this market timing is it allows you to be more nimble and respond to changing market conditions. Now, that's a very good thing if you think you can actually do that. Most people can't. So there are certainly people that can do this, but just be wary that being nimble and responding to market conditions, a lot of time that leads to over trading, which gives you high transaction costs, high tax costs, means you're likely chasing performance. And there is still sort of a notion of reversion to the mean, typically, especially with sort of outsized performance. So something to think about. All right, I put this slide up a lot. We'll talk a little bit about core and satellite. So basically, the concept behind core and satellite, and yes, that is a picture of me. Core and satellite basically just refers to an investment strategy where you are going to use a passive ETF or a fund for the majority of your portfolio. And you're going to understand that, okay, I am going to at least match the market minus fees with my core portion of my portfolio. But then I could look to some opportunities to actually outperform the market, whether I put 10% of my portfolio into something that I think is going to outperform. That, if I'm right, of course, that allows my whole portfolio to outperform the market because your core will get dragged up. If I underperform the market and picked a terrible investment, at least I didn't put all my money into it. So you hear all sorts of different ways of describing this. So some people say they're fund money, where they want to put it on more speculative bets. You hear lots of different descriptions. I don't think it's necessarily a bad approach. I think at least it's acknowledging that a lot of people, most people, sort of suffer from this fear of missing out. And this is a way to sort of give into that part of human nature that makes us want to go out and buy some thematic ETF because our neighbor bought it and they're loaded now, or at least the way they talk about it. So that's core versus satellite. So this would be, once again, focusing very much on asset allocation, focusing on passive investments in this core section, and then looking to take a punt on a couple things for the lack of a better analogy. All right. And then, of course, I always talk about the buckets. So I thought it'd be appropriate that we ended the year on buckets. So once again, this is this notion of how do I manage this transition to retirement phase? Is the bucket approach a way to do that? Knowing about sequencing risk and knowing about longevity risk, that I keep a couple years worth of withdrawals in a cash bucket. Means that if the market goes down significantly, and the more you put in the cash bucket, obviously, the more volatility, the more years of volatility you can withstand, but the lower your overall returns are. But that allows me to, quote unquote, weather the storm while the market is falling significantly. And then I don't have to sell my other bucket. So basically, you've got this long-term bucket. This long-term bucket is sort of focused on longevity risk. So you have a lot of growth assets in there that are long-term assets. That is making sure that you do not get too conservative early in retirement, knowing that you have a very long time frame of retirement. So that's that bucket. And we've got some intermediate term assets. So we've got some maybe higher quality shares, some fixed interest that's lowering the volatility of your overall portfolio. But once again, this cash bucket's getting you through this sequencing risk. All right, so we've got a question from Phil. So he's saying a buy and hold strategy would presumably ignore the 1-star rating to sell, Morningstar premium to fair value. Yeah, I mean, what I would say about a buy and hold strategy, and honestly, it's what I do. I have very long holding periods on most of the things that I own. Yeah, I mean, I worry less if something gets a little bit overpriced. So when we're talking about sort of the Morningstar ratings, which Phil is, so 5-star rating is the biggest discount between what something's trading for and what we think it's worth, and 1 star is the opposite. So yeah, I ignore them. What I would say, I don't ignore them when I'm making purchasing decisions, but I'm not going to automatically sell something when it starts moving up to more overvalued. Once again, it's something where I'll revisit my thesis, but I do know that selling something obviously triggers tax consequences. I have to figure out where to put the money then. So there's all sorts of reasons. So I would generally, if I was holding something for a very long time, worry less about sort of where it was, where the very short-term valuation was. So Phil's saying Peter Lynch recently criticized passive investing. I'm guessing ramping his business interest. So Peter Lynch, of course, is the very famous portfolio manager for Fidelity Magellan. So very different from Magellan here. And he wrote a book called One Up on Wall Street, which is a very popular investing book and a good book. So he did very, very well running this giant mutual fund in the US. Yeah, that's Peter Lynch. All right, so we've done it. If there's any more questions, of course, you can reach out directly to me, mark.lamonica1@morningstar.com. I do hope, thank you guys very much for joining. I appreciate it. And I do hope that everyone has a great Christmas and New Year's or whatever other holidays you're celebrating. As I said, I'll be back in January. We'll do a slightly different approach. It's going to be more structured. So I'm not very good at being structured about stuff, but Shani has imposed some structure. So we're going to have some more set slide decks that she'll create so they're done correctly. And we'll do some quizzes and all sorts of good stuff. So anyway, I'll be back next year. So I hope everyone has a great break. Martin Wright, ho, ho, ho. All right. Thanks, guys.